Hey everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. On today's episode, I welcome Director of Tax Sean Richards back onto the show. Now that he has had a chance to take a breath from the last few months working toward the tax filing deadline, I picked Sean's brain about some of the most common blunders that he saw pharmacists make throughout the season and how year-round planning can help individuals not only avoid these mistakes, but also optimize their tax situation. If you're looking to learn more about how YFP's comprehensive tax planning service can help you and your tax situation, go to yfptax.com. Again, that's yfptax.com. Okay, let's hear from today's sponsor, and then we'll jump into the show. Does saving 20% for a down payment on a home feel like an uphill battle? It's no secret that pharmacists have a lot of competing financial priorities, including high student loan debt, meaning that saving 20% for a down payment on a home may take years. We've been on a hunt for a solution for pharmacists that are ready to purchase a home loan with a lower down payment and are happy to have found that option with First Horizon. First Horizon offers a professional home loan option, aka doctor or pharmacist home loan, that requires a 3% down payment for a single family home or townhome for first-time home buyers, has no PMI, and offers a 30-year fixed rate mortgage on home loans up to $726,200. The pharmacist home loan is available in all states except Alaska and Hawaii and can be used to purchase condos as well. However, rates may be higher and a condo review has to be completed. To check out the requirements for First Horizon's pharmacist home loan and to start the pre-approval process, visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. Sean, welcome back to the show.
Thanks for having me. Yeah, feels like it's been a while, but I think that just because tax season tends to, slow time down for some of us over here.
You look much more rested than I saw you just a few weeks ago. So here we are on the other side of the tax filing deadline. We're going to talk all in this episode about some of what you saw this season with the hopes that pharmacists can prevent some of those mishaps as they work throughout the year on their taxes. But looks like haven't had a chance to maybe recharge and refresh on sleep. So how are you feeling post-tax deadline?
Yeah, I'm feeling great. I've been catching up on some of the things that have been put on side burners, so to speak, but definitely getting a little bit of sleep, catching up with the family and stuff. It feels good. I'm well rested. There's still some things to tie up from last year, but ready to move forward and look ahead to next year. And like you said, try to hopefully get some of these ideas in people's minds so they can plan now and not have any of these kind of hiccups or roadblocks come up next year.
So give us the rundown. I know there's still work to be done with some of the individual and business extensions and some of the more complicated returns, but how many returns did you and the team do thus far?
We did over 200 federal returns and a similar number on the state side. So, I mean, if you think some folks have multiple states, some people are in states that don't have taxes. So, you kind of, they work themselves out there. But yeah, over 200 federal returns. We did a fair number of extensions. There's some business returns mixed in there. So it's kind of all over the place, but that's the rough number between a few of us here. So definitely feels like quite an accomplishment here. But yeah, I mean, definitely have some of those more complex returns that we want to give a little bit more TLC to. Those are still hanging out there. So now that we're past the big push, we can really focus and try to maximize savings for those folks. So excited.
Which state wins the award for the most difficult state when it comes to returns?
Boy, I don't know if I'm going to be getting a misery loves company or if I'm going to be jading people, because I feel like a lot of our listeners kind of land in this territory where our headquarters are. But I have to say Ohio probably gets the cake.
Yeah.
Pennsylvania right up there, close second. But yep, those two are probably the worst, I'd have to say. So again, hopefully people aren't sitting there saying, I love those states. And if that's the case, all the power to you, but not for me.
Yeah. And one of the, opportunities, challenges, depending on how we want to look with it, we've got tax clients, financial planning clients all across the country, which is a unique opportunity and challenge when you think about all of the nuances that happen, especially on the tax side, right? On a state basis, or even here in Ohio, we have the RETA, Regional Income Tax Authority. Did I get that right, Sean?
Yep, you got it right.
Which provides another wrinkle. So it's fun to hear you and the team complain about Ohio and PA, and some of the other states perhaps are a little bit easier. So let's jump into the most common mistakes, Sean, that you and the tax team saw pharmacists making. And we've compiled these on our website, yfptax.com. If you want to download these and read a little bit more information on each one, please do that. So we're going to go through these one by one. And again, the hope of this is that we really want to shift the perspective around taxes, that the only time we think about taxes are April when we're filing, right? This really needs to be a proactive year-round planning. We'll talk more about that at the end of the show. And that's why we thought, hey, here we are in the month of May. Tax season is over, but this is not a put it up on the shelf, worry about it till next year. This is the prime opportunity to really be learning from the season that just was and looking at the opportunities ahead of how can we best optimize the situation before we get back into the filing next year. So again, if you want to download a copy of the guide where we talk about some of these mistakes, you can go to yfptax.com and do that. So number one on our list, Sean, perhaps the most common, I would presume, you can tell me if otherwise, is folks that got a surprise bill or a surprise refund when they got to filing. So my question here is, tell us more, but what is the usual cause of these unwelcome surprises?
Yeah, I would say that's the most common, and it's probably purely because if you take a lot of these other things that we'll talk about, they all sort of work their way into that at the end of the day. You know, if you're making a mistake somewhere along the way, you're probably going to end up with either a large bill or a large refund, so it kind of encapsulates everything. Yeah, and just to kind of go back to your point before, this really is the best time to be looking at these things. I mean, any time of the year is good, but when you're coming off tax season, you might be disappointed or looking at things saying, that didn't go the way I hoped it would. I had a bill or I had the refund. You don't want to just kind of say, finally, I'm done with it. We're past the 18th. I'm filed, and sort of, shake your hands off and say, because what's going to happen is you'll be in the same spot next year. I mean, I know taxes aren't something that people love to think about and want to be excited about, but it's one of those things where if you sweep it under the rug, it's not going anywhere. It's only going to grow under there. So yeah, the surprise bills and refunds, I mean, that can really be a litany of different things that can cause it. The biggest thing I would say probably by far is really just simply not withholding correctly at your job. Mm-hmm. And this one frustrates a lot of folks, and I don't blame people because, people will say, hey, I've been at the same company for a while now, or my situation's not that complex. How could they not be withholding properly? And I have to say, as a tax accountant, I don't love the new W-4 that the IRS rolled out a few years ago. If anyone working for the IRS is listening to this and they want to, give me their opinion on it, feel free. My line's open because, I'm a tax accountant.
I don't think we have many pharmacists or IRS.
Hey, you never know. Sean. There's a little bit of overlap here. This isn't. You don't have to be a pharmacist to listen to the pod, but no, I mean, with that one, I really wish there was a way as an accountant to be able to say, hey, withhold 18% from this client, please. Just withhold 20% from this client. But it's not that simple. I know what they're trying to do. They want to make it more user-friendly where folks kind of can't mess that stuff up, or if they don't know how to come up with that number, it's supposed to kind of guide you through it. So I think the biggest thing there is that the W-4 is sort of designed to try to pick up everything else that's going on in your financial life aside from just that one job that you're working. And typically what will happen is folks will get married and they won't update their filing status, or they'll get married, or maybe not even get married, but say they already were married, their spouse gets another job, they have a side gig. And these are all things that, if your company, your system doesn't really know that that's happening, right? So if you're making money off to the side, doing another job, you work multiple jobs, your spouse works multiple jobs, all those things factor into what your tax bill is going to be at the end of the day. And if your company doesn't know what's going on, then it can't withhold properly. And I say your company, the payroll company who's kind of doing all that stuff behind the scenes. So that one is tough because there's not a perfect answer. Yeah. Really, the best way to do it is to take a look in the middle of the year and say, okay, where am I at? Where was I at last year? Obviously, if you had any kind of issues last year, you can submit a new W-4 now to change that. But doing a projection mid-year, take a look at what you've already withheld, what you withheld last year, and try to tweak that now. That's definitely the best time to do it.
Yeah, and we're going to come back to that topic, Sean, of a mid-year projection, why it's so important on the tax side as we get into the summer months. So stay tuned for more. Again, we're going to be talking tax all throughout the year as we think it's certainly an important part of the financial plan. So that's number one, would be a surprise bill or refund at filing. Number two, Sean, not taking advantage of tax laws. This makes me think of some of the recent changes that you've talked about before on the show surrounding the Inflation Reduction Act, the electric vehicle credits. I know this seemed to cause a fair amount of confusion and concern this year during tax season, maybe some surprises as well. So what are you referring to here as it relates to not taking advantage of the tax laws?
Yeah, and with that in particular, I mean, we keep kind of harping on the energy credits, but that's where the tax law tends to be going now. I mean, all these things that are coming out, there's changes sort of across the board, but the biggest piece and where the biggest dollar savings are tend to be these renewable energy credits, improvements to your home that are energy efficient, things like that. And yeah, at the end of last year, the Inflation Reduction Act went in, and there was a lot of confusion as to which credits change, when those credits change. So some of the electric vehicle stuff happened at the day that the law actually went into effect, whereas some of the other energy credits like at home improvements, like I mentioned, windows and things like that, didn't really increase until this year, 2023 going forward. So there were folks who spent money last year and were expecting a larger credit for their taxes in 2022 and didn't see that. So it's really just, it's difficult to stay on top of the tax law, especially if you're not a tax accountant or aren't familiar with those types of things, and especially if you want to stay out of politics too. But it's really challenging because this is one of those things where if you're not spending the money in the right time frame, it's not something you can go back and change after the fact. If you put windows on your house now, that's a 2023 event. When we're doing your taxes in 2024, we can't say, hey, I wish you had not done your windows because they're already done. So it's something where it's really important to make sure that if you're spending money thinking that you're going to get a credit or hoping you're going to get a credit, really understanding when those things go into effect, what the dollar value is, and what the limits are. That's another thing, is that some of these things, they're increasing the limits, but they do still exist. So, if you spend $50,000 on an improvement, you're not necessarily going to get a $50,000 credit.
Yeah. Yeah, and we've got some info on this, yfptax.com. We're going to be updating this throughout the year as well, so make sure to check out the information there. And Sean, this is just another testament to why the year-round planning is so important, right? If we're looking at this in the tax year, so here we are now in 2023, obviously next spring 2024, we'll be filing for 2023. At that point, right, decisions have been made in terms of what happened during that year. So are there adjustments that we can be making mid-year? Or are there, tax laws and situations like this that we can make sure we're up to speed, or at least have the right understanding before we make some of these bigger purchases that may or may not have the impact that we're hoping they're going to have? So that's number 2, not taking advantage of the tax laws. Number 3, Sean, I have to say this one pained me a little bit because we've talked so much about this on the show,
So much.
which is underestimating the power of the HSA, the health savings account. We've continued to emphasize how this not only has tax advantages, but we still see this as an underutilized tool in terms of the financial plan. So tell us more about what you're seeing here.
Yeah, I think with the HSA, it's one of those things where people think, oh, I need to have a lot of medical expenses to take advantage of it. If I'm putting money there and I don't use it, I'm not going to get the full advantage of it. But really, you need to not have that mindset and really think of it as a secondary retirement vehicle, basically, where if you do have expenses that you need to take advantage of it, it exists for you. But if you think of it almost as a second IRA or something like that, then it kind of shifts that mindset of, oh, I need to have these health expenses. But yeah, HSAs, I know ad nauseum we talk about it, but they have the triple tax benefit. You get the deduction for your contributions, you get tax-free growth, and you get to take it out tax-free. So you rarely see that triple tax benefit. This is one of those ones where there is a little bit more flexibility. I just mentioned some of those credits and having to get the dollars spent during the year.
Yep.
You have a little bit of flexibility with the HSA where you usually have up until the filing deadline to actually make contributions. Or on the flip side, and we saw a lot of this, is people who worked multiple jobs or got married and kind of weren't talking to their spouse and over contributed. So you want to make sure if you did that, you pull that money out so you avoid any penalties there. And again, you have a little bit of flexibility after year end to make those changes, but to any extent you can avoid that, obviously it makes sense. But yeah, the limits are going up next year. I think $77.50 for a family plan. You have to be on a high deductible plan, but if you are and you're not taking advantage, you're really just losing out on that benefit, honestly.
Sean, I'm glad you mentioned the over contribution, mishap that might happen here. And I think it's a good reminder. If Tim Baker was in my ear, anytime we talk about backdoor Roth IRAs, he's always beating the drum of, really there's a lot of nuances to consider. And we see on the planning side, our planning team works with a lot of folks that, are trying to unwind some of the mistakes related to the backdoor Roth IRA contributions. And I think it's a good reminder that, as there's more and more information out there, right? We talk about HSAs, it's readily available, something you can learn about. That, we still have to cross our T's and dot our I's. And I think having someone in your corner, right? Financial planner, tax professional, perhaps both, that can help make sure we're executing this properly. Really, really important. Number 4 on the list, Sean, taking non-qualified IRA distributions. We were talking before the show, perhaps maybe even a little bit broader than IRAs. Tell us more about this one.
Yeah, IRAs are really just kind of retirement plans in general. I know we just mentioned HSAs, they're sort of a secondary retirement vehicle, but just not taking advantage or properly utilizing IRAs. So we'll start with the IRA piece. There's a couple different things there. You can get a deduction for traditional IRA contributions. Folks typically phase out of that pretty quickly. And then the next kind of phase out level will be your Roth contributions. And kind of what you were just alluding to is that folks also kind of pretty quickly phase out of that as well. And that's one of those things where you don't want to end up at the end of the year saying, you made too much money, but you already contributed this to your Roths. And now you got to go back and pull it out and then try to do the back door that Tim was talking about. So yeah, to any extent, again, you can have somebody in your corner where you can say, hey, this is what I've done so far this year. Does this make sense? Am I going to over contribute? Am I going to be in a good spot? Do I have room to contribute more? Definitely makes sense to do. And again, the IRA limits are going up next year. Again, the contribution limits. So taking advantage of that makes a lot of sense. And the other piece that you didn't really mention there, but we kind of alluded to, is just retirements in general. I mean, 401ks at people's businesses, not taking advantage of those, having extra cash on hand and not maxing out your 401k, whether it's a Roth to get the benefits in the future or traditional to get that tax benefit now. I mean, either way, we saw a lot of situations where folks had a lot of cushion there and could have contributed more. And that's one where at 12/31, you can't go back. So can't turn back time, got to get those in before the year. And again, having someone in your court to say, hey, you've only contributed up to 30% of your 401k and we're already in October, you might want to do some catch-ups, really important.
Sean, did you get any feel? I'm just curious from folks that, if I heard you correctly, it looked like there was margin there. They could have made those contributions or was cash on hand, but didn't. Is that just hey, we overlooked it? Or do you have a sense of, with some of the volatility in the market, inflation, what's going on in the broader economy, that there's some hesitancy in the contributions into the retirement vehicles and people wanting to hold on to more of that cash?
It could be a lot of different things. I mean, it could also just be an education thing. I mean, I know even when I first started out at a corporate job coming out of school, you get all these different paperwork and everything, and they say, okay, here's your 401k, here's this, here's that. And you're just, saying, okay, I want to get the company match. Great. Yeah. I'll put this amount down and everything. And you don't really realize that, you have a limit that you can hit yourself and kind of capitalize on. So I think it's really just a matter of, maybe not looking at cash flow, like you were saying, potentially not taking a look at that in the middle of the year. I don't think there's a whole lot of hesitancy with the market or anything like that. I think it's more just a matter of you kind of set it and forget it. And, you come to the end of the year and somebody says to you, hey, did you know that you could have knocked $5,000 off of your taxable income if you had contributed more to your 401k? And a lot of people just say, I didn't know that. So,
yeah. Seeing the numbers, right, I think can help in hindsight. And, once you see the impact on the tax situation, you're like, all right, got it. Point made. I'll make that correction for next year. Number 5, Sean, I think is one we have not yet talked enough about on this show, which is not employing a bunching strategy for charitable giving. So here we're talking obviously about donations and really looking at how to potentially alternate as you look at the standard deduction and then bunching these in those off years. So tell us more about this one.
Yep. So this one is more of a unique scenario. It's one that we always take a look at, but not everybody's going to fall into this bucket. But if you do, it's something that if you're able to take advantage of, it can be very, very powerful. So the idea of bunching is really trying to pull itemized deductions as much as you can into one year. And then in the next year, not having as many and taking the standard deduction because it's just getting higher and higher nowadays. I mean, just the number of folks that we see taking the standard deduction, even though they have things like mortgage interest and taxes that they're paying for, still taking advantage of the standard deduction because it's so much higher. So yeah, if you're looking at it and you say, hey, I was $500 away from the standard deduction, or I itemized $500 more than the standard deduction this year, and you had quite a bit of charitable contributions, if you're able to, again, sort of pull those in and say, hey, if I'm going to do $1,000 over the next 2 years, I'm going to do $1,000 this year and maybe not anything next year. And you can do it on 12/31. So you kind of get the same, feel for giving to the charity. But if you're able to do that and take advantage of it, it can be really powerful. And that way you're not losing out. That was one thing we got a lot of is, hey, I have a house and I pay this mortgage interest, but I am taking the standard deduction. So am I losing that benefit? And it's not the best way to look at it, but you're not really getting the full benefit of it if you're doing it that way.
Yeah, and as you mentioned, this really applies not necessarily to everyone, depending on, amounts that folks are giving, but especially for those individuals that are giving, additional dollars to various organizations, churches, nonprofits, communities, et cetera. There could be some real benefits to the bunching strategy. And I'm, one who is victim to this in terms of just behavior, right? Where you might have contributions on a automatic monthly payment, or you're planning for it throughout the year, and you just don't take the time to take a step back and say, okay, from a strategy standpoint, I'm going to do the standard deduction this year, and then we're going to do the bunching strategy next year. So again, just some proactive planning to make this
Yeah,
happen.
and it doesn't always work for everybody because I mean, I
Right.
talked to people who said, hey, that doesn't match my giving strategy. And that's perfectly fine. It's
Sure.
really just
Yep.
if you want it to, help out your financial strategy, there are options out there. I'm not saying you should change the way you give to your
Good
charities.
point.
It just
Yeah.
exists. Right.
Number 6 and number 7 are, specifically for folks out there that are earning some additional income, side hustling, business income. So number 6, Sean, not saving for taxes when earning additional income. Sounds obvious, but we see more and more pharmacists that are dabbling in various side hustles, consulting businesses. So I think this is becoming a more prevalent mistake, probably one that maybe you make once and then you don't make again, but talk to us about what you're
Hopefully.
seeing here.
Yeah, so I mean, it does sound simple on the surface, but again, if you're not used to it or it's not something that you've kind of done before, it's not second nature, I guess. So right, if you work a W-2 job, that federal income tax is being taken out, hopefully correctly. Although, as I mentioned in the first thing here, sometimes it's not correct. But hopefully your income tax is being taken out at the end of the year. You sort of do a true up, and maybe you owe a little bit, maybe you get a little bit back, but that's that. If you're making money that's outside of a W-2, whether it's investment income, capital gains, whether it's a side hustle, really anything where you're not seeing that federal income tax withheld line, you better be putting taxes aside or being ready to pay that at the end of the year. And like you said, typically that's one where if you make the mistake, you don't do it again in the future. But I think some people are just really excited about making money and they want to pour the money back into their business, which is perfectly fine. We want to encourage people to build their businesses and invest back in, but just make sure you're setting aside enough at the end of the year to kind of make sure you have at least a little bit of a cushion there and having somebody to do that calculation for you, because, just because you think you're going to net this much at the end of the year doesn't mean that that's what your tax bill will be. I mean, there's lots of ins and outs there, different things you can do. So having somebody to be able to take a look and say, hey, as of right now, you've made 50K of non-withheld income. So you're going to want to put 20% of that aside, 25% of that aside. Just be ready for it.
Yeah. And I think there's here a couple pieces you're highlighting, right? Which are the mechanics of, where do I save it? How much should I be saving based on how much I'm earning? And then at what point do I need to be making quarterly estimated payments? And I do this, right? I reach out to you and say, hey, Sean, we're coming up on the Q1 estimated payment, like based on what we're seeing in terms of the financial statements, like what's the plan? And then we're saving in a tax account, along the way to be ready for those payments. So good thing, right? If you're paying tax, you're growing a business. So
exactly. And I will admit, the IRS estimated payment process doesn't really even feel that natural. I mean, you're kind of doing the math yourself, going onto the website and just saying, all right, here it is. And they just take it. And then, at the end of the year, it does. It comes into your play. It's one of the lines where you basically say, okay, what did you withhold? What did you pay in? What did you owe? And we do the math on it. But it just feels like you're sort of just sending money out into the abyss when you make the payment. So I kind of understand that folks are a little apprehensive and would rather hold off. But again, I mean, I'm conservative. I'm a tax accountant, but at the end of the day, I'd rather get a little bit more money back than owe a lot of money.
Yeah. And Sean, separate conversation for a separate day. This is a little bit more to the business strategy, but one of the things I like about withholding, at least quarterly, but at least on your own side, even on a monthly basis, is it forces you to look at the financials of the business a little bit more closely, right? So I think there can be a tendency, if I'm not paying tax and then I'm either caught off by a surprise bill, or I just wait until the end of the year and pay it, you may fall into the trap of assuming your business is more profitable than it actually is. And so really looking at, what is the service, what's the product you're offering, and what's the true financials if you're considering the tax.
And not to go too far off, but another big thing is that a lot of people kind of just assume that cash and profit are the same thing.
Exactly.
And that's not always the situation, right? So, you could have a big profit at the end of the day, but if you're pouring that cash back in, you might not have any cash on hand. So they don't always go go one for one. And if you get away from that, it can really end up causing some problems for sure.
Preach it, Sean. We need to come back and do an episode on that. The difference between cash on hand and profit of a business. So that's a good one.
Yeah, that one I'll make a note because that could be like a double episode. But yep, I'll put that one on the back burner for sure.
So that's number 6, not saving for taxes when you're earning additional income. Number 7, also for our side hustlers and those that are running a business, not expecting the FICA tax on self-employment income. Tell us more about the FICA tax here.
Yep. So that's kind of similar, very similar vein as to what we were just talking about, really just having to kind of put that money aside. But again, something that's not second nature, not something that you'd really be typically thinking about until you get into this and potentially make a mistake. Hopefully not. But right, when you have these W-2 jobs and the money's being taken out, you're withholding for yourself and you're paying Social Security and Medicare, which we call FICA, for yourself. Your employer is paying half of that for you, whether you realize it or not. And when you are self-employed, so you have a partnership or your own kind of business and you're getting that money in, that you have to pay that portion of FICA yourself. Now, the benefit is that get that employer portion that the employer typically would be paying for you on a W-2. You do get that as a deduction, so it helps a little bit. But yeah, I mean, that, what is it, 15.7% or whatever for FICA is coming out of your bill at the end of the day. So on top of the regular income tax that you have to set aside, you should really be saving for that as well. That's where you heard me saying before, 20, 25%, maybe up to 30%, depending on what your bracket is. You start to add that FICA in on top of it, and you could be looking at quite a bit to be setting aside.
Yeah, Sean, this was one, I would add to this as well, the surprise of the cost of health insurance. This is one as well. You put those together and you go from a W-2 job to running your own business. It's like, oh, okay. So again, right, you're looking at the financials in a very different way.
Yep, exactly. Things to keep in mind.
Number 8, Sean, has to do with some of the mishaps and mistakes with employer-dependent care. Tell us more about this one.
Yeah, so there's a lot of different things with dependent care benefits. So you can have dependent care FSAs. So that's a little bit different than the HSA, but with that one really is a little bit more of the, I was saying with the mindset with an HSA, if I don't have medical expenses and I don't use it, it's not going to be worth it for me. It turns into an investment vehicle if you don't use it. Dependent care FSAs, flexible spending accounts, if you have cash in that is more of a, if you don't use it, you lose it kind of thing. So that's something where if you're putting cash aside there, pre-tax dollars, you want to make sure you're using that for dependent care expenses during the year. And the other thing is that if you're getting benefit from your company, you want to make sure that you're also putting that and actually spending that on dependent care. And when I say that, I mean a nanny or a daycare, or even if it's a family friend, but somebody that you're, putting their Social Security down and saying, hey, I paid this person this much money to watch my children. Otherwise, that can become a taxable event. So you want to just make sure that if you have kids, you're getting these benefits, that you're utilizing the cash during the year and not kind of ending up with excess in those accounts at the end of the year. Exactly.
Number 9, Sean, an oldie but a goodie, one that I think has lost some attention given the 3-year loan pause, and that is not factoring in PSLF when choosing a filing status. Tell us more about this one.
Yeah. And this one, I mean, you just alluded to it. It's been very, very challenging, especially with the client base that we work with, having that ambiguity on what's going on with the loan system and trying to give guidance on this front, because it's really tough when you're saying, hey, we're not exactly sure if they're going to turn back on and how all that looks and when we're going to have to recertify all these things. But yeah, what we're talking about here is that typically when folks get married, filing joint tends to be the best approach there. And we always do a comparison, at least on our side, to say, okay, all else equal from an objective tax standpoint, filing jointly will save you X number of dollars versus filing separately. But when you're talking about PSLF and you get into these income-based repayment plans and they're looking at AGI, that can really swing very, very rapidly between what your AGI is as a married filing separate individual versus your combined AGI with your spouse when you're filing joint. So this is one where it's a classic, like you just mentioned Tim Baker, the old it depends. It really depends on your individual circumstances here. You're going to want to look and say, hey, what do I have on my side? What does my spouse have on their side? If you separate us, what does that look like? What is my income-based repayment plan? What numbers are they looking at? And really, and like we just said, when do I have to recertify these things? When am I going to have to make these payments? Because it's a matter of, you could save $200 by filing jointly this year, but if you're saving $50 a month on your payment by filing separately,
That's right.
that adds up very quickly. So it's something
Yeah.
where there's a lot of moving pieces, but it's something where if you're not looking at those pieces, you can very, very quickly end up spending a lot more money than you'd think.
Yeah, and it's so important, we're talking about PSLF here, but the intersection of student loans and the tax, strategy is one of many examples where the financial plan and the tax plan need to be jiving. And this example specifically brings us back to the origins of YFP Tax, right? I remember Tim Baker talking about, hey, we would develop these beautiful student loan repayment strategies and plans. And then there'd be hey, go talk to your accountant. And not all accountants are well-versed in student loans, which is fair, right? Based on how nuanced they are. And right now, how rapidly this information is changing. So shout out to you, Sean, the YFP tax team, working with a tax preparer, working with an accountant that understands student loans. Again, this is just one example, but really the intersection of the financial plan and the tax plan, so important. Those are jiving in the same direction.
Yeah. And like you said, I mean, not all accountants know about it. And I know enough to be dangerous with it, but you have to have financial planners that know about that too.
Yeah.
I mean, that's something where I could be working with you and say, hey, I think from a tax standpoint, it looks like this, and you could go bring that to your planner. And, if they're not really thinking about these implications, it can really get away from you quickly. You're right.
Number 10 on our list of 10 common mistakes, mishaps that pharmacists were making during the most recent tax season is overlooking considerations with cryptocurrency. I mean, what would be a tax episode if we didn't talk about crypto and digital assets? So what do we see here?
Well, this one probably is a little bit different than we've seen in the past with crypto. It wasn't so much that we were seeing people with these big gains that they weren't necessarily expecting. In fact, if anything, it might have been the opposite given what kind of happened with the market and everything last year. But in that, what I would say with that is, if you kind of take the gain loss implications aside, the biggest thing I would say here is just the reporting aspect of it. So cryptocurrency, again, and I feel like I harp on this all the time, is crypto is treated like an investment as far as the IRS is concerned. It's like a stock. So if you go and you're, doing all these microtransactions all the time and you're using your crypto wallet to buy coffee down the street, that's effectively saying, okay, I'm going to sell X number of shares at this price on this date, whatever I bought it for back in the day, that same security, you need to look at what your basis was and do the math. So if you're doing hundreds and thousands of these transactions every year, the reporting implications are significant. And that's not something where you can say, and I'm not just saying this because I'm an accountant and I'm biased, where you can't just say to your accountant, hey, here's my list of 1,000 transactions, figure it out for me. You need to make sure that whatever system you're using can spit that out in a digestible manner, whether it's actually getting a form from the IRS or kind of getting a summary. And one thing that we've seen is that a lot of these companies, and I don't blame them necessarily, but a lot of them will kind of rope you in and say, hey, it's going to cost you $5 a month for the basic crypto wallet and everything like that. And then you get to the end of the year and all the tax forms that you need will be kind of an extra charge and you're not thinking about it. And folks will say, well, I have an accountant, they can kind of do that for me. But I mean, again, and I'm not just saying that because I don't want to do it. It really is a matter of, an accountant simply can't take thousands of transactions and stick them onto a form. It's not a practical thing that can happen. So you want to make sure that whatever you're doing, and again, if you want to do all those transactions, hey, power to you. But keep in mind, it's like you're selling shares. You need to make sure you're getting something out of your system that an accountant can then use and file your taxes with, because it's not like spending money. It's like selling stocks.
Yeah, I'm hopeful, Sean. This is another one, where you kind of make this mistake once and you maybe approach it differently in the future, right? I think this is an education where your explanation is spot on. If we look at this in the eyes of the IRS, which is that we're making a transaction in terms of like we were selling a stock, and especially if we're using it to purchase things on a daily basis, right? Store, a cup of coffee, groceries, whatever. Like we don't think about our stocks like that typically. And so I think that, not to say people may not, transact crypto for purchases, just like you would dollars out of a brokerage account, but maybe not on the frequency, that it's happening if you're able to think of it in that way and understand the reporting and the tax implications there. So great explanation.
Exactly. I think, like I said, that the basis is really the biggest thing. And people, if you talk to me, you'll hear me say it all the time and you're probably sick of it, but it's really being able to trace back and say, again, like it's like a stock, right? So if I sell XYZ NFT today, I need to make sure I know what I purchase XYZ NFT for in the future.
Yes.
And when you're doing all these things and you're day trading, so to speak, and saying, all right, I'm going to flip this one here and I'm going to go buy crypto with this one and kind of moving, each one of those things has to be kind of traced back to the origin.
Yeah.
And, if you don't have that information, you could end up paying more, honestly, if you don't have the basis information and you're just going to end up reporting it on your sale price and not have the basis in there. You could end up either paying more or, again, reporting it incorrectly. Both of those are not what we're hoping for on our side, at least.
So if anyone heard Sean correctly, as I heard him, all of your handwritten crypto transactions, your reports, your chicken scratch, you can email those to srichards@yourfinancialpharmacist.com. He will gladly.
I will go through all of it in all of my free time now. Absolutely. I'll break it all down for you, please.
Awesome. So that's our 10 common mistakes that you saw pharmacists making throughout the tax season. Can I add one more? We're going to do a bonus round here for a moment. And
yeah, go for it.
I think we need to do some education around extensions, right? I think this is an area where, I know firsthand the first time I extended several years ago, and, I've gotten used to that practice now. It can feel uncomfortable. Am I doing something wrong? Does that mean I'm delinquent? But as you alluded to at the beginning of the show, with some extensions that are happening, the more complex returns, we want to make sure that we have the time that we need. The misperception, I think, I could be wrong, that's out there is extension means bad or extension means delinquent, but that's not the case, right? So tell us more about the use of extensions and why they may be appropriate.
Yeah. Glad you're giving me the bonus round. I would have had this as 1A on my list if I would have thought that you would have actually allowed me to record this podcast if I did that. I thought that if I came over the top with that one, we might be, deferring this recording out to a future date. But no, extensions. So it's actually kind of twofold. I would say that from who I've talked to, and this could be clients, even family members that I was talking to during the tax season, checking up on how things were kind of going. I would say with the negative connotation, it's one of two camps. It's either, hey, extension means bad and delinquent, or extension means, hey, I'm, this crazy tax guy who has offshore accounts and, I make $5 million and I need to have my accountant spend the extra time to do all this stuff. Those are really the two mindsets that I got a lot of. Like I said, I talked to people that I've known for a long period of time who I consider to be financially sound individuals. And they said, oh, extensions, those must be for your big ticket clients, right? And the answer is not really. Extensions simply give us, your accountant, and you more time to get your things together, to allow us to dedicate the time to find you tax savings, get your things right, and not rush them. And I know Paul on my team, who I'm sure you've heard talk on this pod before, but he'll always say, if you have a surgeon who needs to do 1,000 surgeries in a year, would you rather him do them all in 3 months, or her do them all in 3 months, or have them do it throughout the course of the year, X number during each month? So you got me all fired up because, extensions are near and dear to me. But really what it comes down to is, we're trying to do a lot of different returns, and a lot of people have very complex situations, and we want to make sure we get it right. We talked about states and local, moving states and making sure states don't talk nice to each other. Even ones that border each other are not, don't always agree with how things are picked up and everything. And just getting all that information together, making sure we can parse through it, maximize your tax savings and everything. Extensions just give you the time to do it. Now, the one thing I will say is it does not extend your due date to pay. That's the biggest thing. So what you want to do is get an estimate,
right?
Make a payment if you think you're going to owe in April or even beforehand. But after that's done, it really is a one-click kind of thing. It's an automatic extension. Once you do it, it's 6 months. You get until October, and that's that. It really is not for delinquents. It's not for folks who didn't get their stuff in on time, or like I said, are using offshore accounts to do X, Y, and Z. It's just simply to give your accountant more time to get it right.
Well, thanks for allowing me to throw some kindling on the fire. So I appreciate that. But
thank you.
I think it's a good reminder, not only in the perception of it, but also, some folks may hear this and say, well, there's an opportunity cost that if I'm getting a refund and we don't file that for, 3 months, 4 months, 5 months later, whatever, that those dollars could have been used elsewhere. True. But my counterpoint to that would have been, one, if we're planning correctly throughout the year, we shouldn't be expecting a massive refund. And second to that would be is that most often extension doesn't mean we're butting up against the October deadline. It means that maybe instead of April 18th, it's May 1st or 15th, or even the end of April, or, into later in May, early June, whatever. So, it allows kind of that stretching out of the season to make sure that we're doing the job that needs to be done well. We're optimizing the situation. And I think that certainly for folks that have more complicated returns, I think what we're seeing in the industry, my perception, even with an accountant we used to work with before building our own practice internally, was, hey, you're a small business owner. Hey, you own a bunch of real estate. Hey, whatever, like, you're automatically extended. That's just kind of the process of what they do to make sure that they have the time to do those returns well. So,
right. And like you said, the idea of year-round tax planning is you're working with your accountant throughout the course of the year. You're getting them information. You have rentals. You're getting them, hey, I sold this place in November, and you're giving them the information in November. So your accountant can already kind of have that stuff ready to go. And it's not a situation of you're in March and you say, hey, I forgot, or FYI, I sold my house back in January of last year. Here's the 5,000 documents for it. Can we get this filed next week? And the answer is, we probably can, but, if we're thinking about these things ahead of time, we can spend, the time that we think it deserves to get everything right. And if you're doing that planning throughout the course of the year, you can get 95% of a tax return effectively done through the conversations that you're having with your accountant throughout the year. So, yep, absolutely.
So, Sean, let's wrap up by talking through how the year-round planning can help pharmacists not only prevent these mistakes, but again, better yet, optimize their tax situation. That really is the focus of what you and the team are doing through the comprehensive tax planning, what we refer to as CTP. Again, not just that transactional return, month of April, got to get it done, but really that year-round strategy and planning. So, what is comprehensive tax planning? What do we offer? Why is it needed? Who's it for? And perhaps not for as well?
Yeah, so comprehensive tax planning is designed to really attack everything on this list, right? So it's where you're doing proactive planning and thinking about your tax situation now, and not at the end, or not in the beginning of next year, looking back on this year and again saying, I wish I could have done this, or how could I have done this differently? It's getting ahead of those things now, so you don't have to worry about that. So things like mid-year projections. Hey, let me grab your pay stub. Let me talk about some of those side gigs you're doing. Give me an updated P&L, or even if we're doing your books for you, I'll pull down the updated P&L and we'll take a look. Hey, you've withheld this much money so far. Your side gig's going to make this much money, we think, so far. Have you put that money aside yet? Did you make an estimated payment? I think you should make a payment of this much. Checking in on those things, or being able to have the conversations of, hey, I just bought a rental property. Tell me about the short-term rental loophole, or tell me about what it's going to take for me to be considered a real estate professional and be able to offset some of my active income with this passive income. Or, hey, I just bought the rental and hearing all about all these tax credits. How does that work? How do those tax credits affect my personal return? And then how does it affect my rental property? Are those going to be different? Can I maximize them? These are the conversations that we've been having with folks over the past few months, looking back on last year. But proactive tax planning is, you're having these conversations now. You're having them in May, June, July, and getting ahead of these things. So when we talk about, March and April, that big push, it's really a matter of, hey, did we do what we said we were going to do? Excellent. Great. Okay. What's your tax bill? 0, as expected. Awesome. File, done, good to go. Just really having that phone a friend CPA to ask questions for, hey, you mentioned bunching when we looked at my return last year. You said I was close on the itemized thing. How can I actually employ that now? Or, hey, this is what I've contributed to my 401k so far this year. Do I have room to add more? Things like that. Just getting ahead of it now while there's room to make changes, and not looking back and saying, I really wish I did that.
Great stuff. So, it's again, not only the filing, it's the mid-year projection. It's having an accountant in your corner to make sure we're executing, throughout the year, answering those questions as they come up. So folks can learn more, yfptax.com. You can read more about that service. You can book a free discovery call to see whether or not it's a good fit for your personal situation. And again, whether, you came off the season and you're like, hey, I did that myself and I never want to do that again, or you were surprised by a refund or a bill, or perhaps you have a situation that's changing, right? Could be moving, new job, dependents, acquiring real estate, building a small business. All of these, just a few examples of things that we want to be thinking about and planning throughout the year. So again, yfptax.com, you can learn more and book a free discovery call to see whether or not that's a good fit. Sean, thanks so much for taking the time. Appreciate you coming on post-tax season and looking forward to having you on throughout the year.
Yeah, thanks, Tim. Glad to be back. And hopefully next time we'll be able to talk more about some of these back burner items. So I'm looking forward to it.
Awesome. Thanks, Sean.
Thanks. See ya.
Before we wrap up today's show, I want to again thank this week's sponsor of the Your Financial Pharmacist podcast, First Horizon. We're glad to have found a solution for pharmacists that are unable to save 20% for a down payment on a home. A lot of pharmacists and the YFP community have taken advantage of First Horizon's Pharmacist Home Loan, which requires a 3% down payment for a single-family home or townhome for first-time home buyers and has no PMI on a 30-year fixed-rate mortgage. To learn more about the requirements for First Horizon's Pharmacist Home Loan and to get started with the pre-approval process, you can visit yourfinancialpharmacist.com/home-loan. Again, that's yourfinancialpharmacist.com/home-loan. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.